We have all heard about success stories and with people turning few hundreds of dollars into a fortune, but we have not heard the other side of the coin. So in today's video, we will be diving into the real story of financial loss, the hard lesson learned, and how you can avoid all these mistakes. So if you're someone who is invested or thought of it, this video is a video you can't afford to miss, so stick around till the end. Hi, my name is Francis, and in this channel we'll talk about everything personal finance and the stock market. And if you're new to my channel, please hit the subscribe button, like and comment below this video. And just a disclaimer, I am not a financial advisor. In investing, you can get less than what you invest, and capital is at risk. Remember, past performance do not guarantee future results. One thing that saved me from losing so much money in the financial market is knowing what to invest and how to spread my capital, my exposure to individual stocks and countries. And for most beginners, they are more familiar with individual stocks just because they are more familiar with the CEOs. Like when you talk about the Tesla, you know, it's all about Elon Musk, and when you talk about Jeff Bezos, it's all about Amazon, and when you talk about Meta, it's all about Mark Zuckerberg. These are big and successful companies, but one difficult thing is, as a beginner, you don't have thousands and millions of dollars and pounds to invest in volatile stocks. And most people, in fact most beginners, might not withstand seeing minus 500 or minus 1000 or minus 5 in their investment portfolio. And if you don't address this earlier in your investment plan, it can lead you to delay your starting or even cause you to make bad decisions, thereby leading to a panic selling. One thing that helps transition me from losing money in the financial market to becoming a more consistent and informed person is when I start investing in ETF that tracks the global market. What is ETF? ETF stands for exchange traded fund. Think of ETF like a superfood that contains all the diet you need. You don't need to go buy fish, vegetables, steaks, or even burger. Or if you're like me that needs vitamin D, ETF has it all in one pack. ETF comprises of multiple companies from different countries, from all sectors like the tech, the finance, the health, the agri, or even the real estate. ETF brings it all in, helping you diversify your portfolio with just one click. So when you talk about ETF, you talk about low risk, more return. Now let's demonstrate how ETF works by using a recent example of the Schwab US Dividend Equity ETF. Few days ago, Schwab announced changes and rebalancing of their exposure to the financial market. What does this mean? It means that they are deleting some companies that does not meet their evaluation criteria and replacing them with the ones that they think that has a more positive potential in the future. And below are some companies that are affected in this. 17 companies are deleted from this fund from all sectors, and here are the companies that are added. As you can see from the list, energy and healthcare sector weighs majority of the changes, with energy having 4.60% and the healthcare sector having 4.01%. This is because ETF providers keep track of company performance, reducing all those hustles of checking company statements, the balance sheet, and the company's earnings, reducing tons of hours of browsing and market research. Or else you enjoy all those jargons in school. Basically, if your company is not doing well, the ETF providers will kick you out, replacing you with companies with a more positive outlook in the future. And the insane part is some ETF pays dividend to shareholders quarterly, making it a passive income money making machine. So if you want a lazy passive income this 2025, ETF is surely the best way to go. And when we look at one of the most popular funds, which is the S&P 500, 20 years ago the S&P 500 was dominated by ExxonMobil, General Electric, Cisco System, Pfizer, Walmart, as you can see on the chart. But look at the S&P 500 stock statistics today. When you compare side to side, you will see there is a whole lot of difference with the likes of Apple, Nvidia, Amazon, in fact tech companies taking the lead. Since the launch of these popular ETFs, their performance has been very massive, with a return of about 120% in decades. And this huge return of these funds are powered by the diversification of the fund around multiple companies from different countries, and their fees are very low when you compare it to individual stocks. Now let's look at another beginner friendly relatively low risk ETF that I have in my portfolio using the Fidelity website, which is the Vanguard FTSE All World ETF. So it's the accumulation version, and stick around because at the end of this video I'm going to show you how you can do this yourself to research for the best performing ETF. See the year, which covers the duration we are looking to check. Second, you have the fund, which covers percentage gain for the duration. And the last one is showing you how the fund spread to risk across large companies worldwide. Look down at the fund, you will see how massive this fund has performed. The crazy part is, in 2022, it was down by minus 8.41%, but after 12 months, it exploded, doubling, tripling to recover all those losses. This is why ETF is a bomb. Another fund you cannot afford to miss is the iShares Physical Gold. So this is the accumulation version. That means the dividends are reinvested in the fund automatically, and it has an expense ratio of 0.12%. These funds replicate some physical gold that are stored in some reserve, and investors go bullish on gold, especially during market crash, recession and inflation, especially in time like this. That is why it is called gold is called a hedge against inflation. And when you look at gold charts, you find out that gold is making all-time highs each week. There are two ETF like the Invesco FTSE All World and Invesco S&P 500. This is similar to Vanguard ETF that I explained earlier. The only difference is that they are different providers, with Invesco FTSE All World tracking the global markets an expense ratio of 0.15%, and while the Invesco S&P 500 tracks the American economy with an expense ratio of 0.05%, making it even more cheaper than the Vanguard product I explained earlier. Remember, our aim is to stay in the market for as long as we can, and we have no idea of what is going to happen in the market, whether the price will go down or will go up or will go sideways. But according to statistics, it shows that the time in the market pays more than time in the market. There are thousands of ETF like the X-Tracker Artificial Intelligence. If you wish to invest in an AI-driven ETF, I will have the SPDR S&P 500 ETF. So this is a cheaper version of S&P 500 with an expense ratio of 0.03%. So now let's dive in and see how you can research the best performing ETF to help you make an informed decision. Google, at the address bar, type justetf.com. Click on ETF screener and find ETF. Go to the search bar, type ticker symbol VWRP. Select Vanguard FTSE All World. There you will see expense ratio, fund size, holdings. Scroll down to the charts to see that the monthly and the yearly performance. Scroll all the way down to the top 10 companies. This is where you will ensure that the ETF you are choosing is diversified to different companies and not just one size fits all. You will see Apple, Nvidia, Microsoft, and the funds allocated to each companies in this ETF. Swipe to the left to countries. You will see United States dominates with 61.06%. Below it is the sectors. We have the technology 26.02% and the financials 5.50%. Scroll down to the performance. What I want you to observe is, for the course of months, this ETF, in fact, ETF generally don't perform well, but from 6 months to 1 year, it has a massive return with 85.62% in 5 years. Let's look at the year 2022. This is when COVID-19 pandemic was at its peak. It's down minus 8.17%. But look at the following year or a year before. It recovers and recoups 2022 losses, making a high of 15.40%. This is why you need to think long term in investing. Another thing I want you to know is, let's go back to the beginning. Look to the left at all asset classes. Below, you will see equity, bond, precious metals. Click on equity. You can sort this out using region, countries, and sectors. Do the same with other asset classes. Thanks for staying to the end, and if you like this video, leave a comment below. Tell me how this video have helped you and what you think that we can improve in our next video.